Hi guys, the four major factors of production in any economy consist of the following. So the first one up is land and raw materials. So these are the materials that a firm can use to produce output. Secondly is labor, the labor involved in the production of any unit of output. Then you have your capital infrastructure, investment in new capital as opposed to used. And fourthly, the combination of all of these, entrepreneurship, how it brings it together. So that's our four factors of production. Secondly, we can break time up in terms of costs into both the short run, where we have the individual period of time over which one factor of production is fixed, so at least one factor is fixed, compared to the long run, where we have a situation in which all factors of production are variable. So there are no fixed factors of production in the long run. So there are the two different time periods. So within the short run then, your costs are comprised of two different types. You have variable costs initially, and these are costs that vary with output. So the more quantity that you produce, you must bring in, for example, more workers, and this will increase your costs with quantity. So they vary with quantity. That is opposed to fixed costs, whereas fixed costs are held constant. They do not change with the quantity produced. So different units of quantity are associated with the exact same costs in this case. So for example, if you borrow money, the interest rate on borrowings is fixed. So variable plus fixed costs equals the total cost of doing business in a company. And in addition to these total costs, what we can see is that we add on something called opportunity costs. Now, opportunity costs occur when you're looking at the best alternative. So, for example, in the situation where you have an individual who has, for example, 100 grand in terms of their wealth, and what they're looking at is they're considering one, investing in a bicycle shop, for example, and selling bicycles. Or number two, you could just simply invest it in a portfolio of shares. Maybe that share would give you 5% return, which would be 5,000. What you would have to have is at least from your bicycle shop a profit level of 5,000 because your opportunity cost is 5,000 in that case. And finally, to work out your economic profit, what you do is you take into account all your revenue, so your total revenue in this case, and you take away all your costs, which include your explicit plus your implicit or opportunity costs.